Hello, good morning. It's Tuesday, May 14th. If you think we are left more wiser than yesterday, we're probably disappointed. We've had another small bounce in the market overnight. We saw yesterday that Trump once again came out saying he had a good feeling about the now June meeting between China and the US, where the two presidents are going to meet at the G20 meeting. But we have a lot more about that. But just before we get into that, just a little bit of advertising for today. We start off early this morning where we got Sten Jacobsen, our CIO. He's on Bloomberg TV in London. You can watch him there by clicking onto bloomberg.com/live. Later today, I'll be trying to make heads and tails of the commodity markets right now, the impact of the trade war, the lack of demand we're seeing, the oversupply, and also obviously what's happening in the oil markets with the current tightening of supply and geopolitical risks. So you can tune into that. You can sign up on webinars.saxo. But moving into today's order, Peter, we had the OECD coming out with their leading indicators. If you just explain what it is and what it's telling us.
Sure, it's leading indicators that are trying to forecast where the economy is going to be in terms of activity in 6 to 9 months ahead. And the numbers keep updating and changing. And one of you might recall that we have plotted this chart a couple of times, and the orange line, which is South Korea, which is probably the best indirect exposure to gauge what is going on in China, actually turned around according to the previous numbers we had from a month ago, and the updated figures we got yesterday is actually now showing that South Korea continues to see easing of growth momentum. So there has been an update to the numbers, and the update also impacting China. Now it looks like China with the green line is actually turning around. I don't think that's the case. I think South Korea and Japan is telling the true story. I don't think the numbers are real that China has rebounded. And interestingly enough, you look at the green line, China, look at the easing of growth momentum. It's the worst since the financial crisis, far worse than the slowdown in 15 and back in 11, 12. And if you take the global, the blue line, it's the worst since mid-2009. So, and it's still contracting. So in this current environment, you need to be underweight equities and overweight bonds, and I think more volatility and more risk is coming through the pipes.
And in this environment where we see farmers in the US struggling and where we see Chinese economy not as strong as it has been, you would think that a deal will be reached sooner or later. But obviously there's a lot more than politics getting involved here, and it basically means that the market will be singing and dancing to the noise coming from both China and from the US, and making obviously quite a difficult trading environment. Talking about the trading environment, Kim, we saw the S&P yesterday. We touched that 2,800 level, but then again, Trump came to the rescue with his his comment. Question is, are we bouncing from here? What do you think?
I think we will bounce a little bit today, but I'm 2,800. It is not the most crucial, but it is one of the levels you really should look out for. Yeah, a little bit bounce here today would be off 0.3% this morning or something like that.
It's 0.67-ish in the S&P 500.
Yeah, so but look out for that. If we get a close below that 2,800, well then the 27, 22 is the next, and that could be really crucial. But as you can also see, I circled the bottom there. That's the RSI, the Relative Strength Index. It's negative for the first time since in about little bit.
Since December, isn't it?
Yeah, December we saw that. So we are in a bearish sentiment, but again, I think we'll see a little bit bounce, but it's not long term.
But then at the same time, we're seeing the VIX. We have focused a lot on that because it is obviously a fear gauge, and I think right now it's coming into play once again. We saw that market obviously move all over the place again yesterday, but a relatively strong close.
It's actually the strongest close we have had since January 22nd. As you can see here on the chart, we came back forcefully from that Friday, and as John Hardy and I, we talked about yesterday when we arrived to the trading desk. I mean, the Friday close was very odd. I mean, it didn't make any sense. It was clearly driven by those headlines coming from Trump. It turned out to be a false signal, and I think the close yesterday is much more in line with what's really going on. And as we put out this note on home.saxo, which you can see on the insights, where we sort of grabbed all the key relevant information, and we always talk about this 22, and Sten Jacobsen asked me to explain why is it 22, and I just highlighted this research paper that has sort of apply some mathematics to the VIX index, and 22 is perceived as sort of the equilibrium point in the VIX term structure. So when you flip above the 22, you sort of kick into what's called bear market dynamics, and it sort of become a self-fulfilling prophecy, and it feeds on itself. So that's why that 22 is so important. And as you can see here, we've only touched that a couple of times last week. It doesn't really major. And as you say, Ole, and show with a lot of your great charts, we have this massive short positioning in the short-term VIX futures contract. And we're just waiting for maybe some, that things could blow up spectacular, but it hasn't really happened yet.
So really, the 22% level is the one we should keep an eye on out there. Just to be staying on the theme, Peter, you mentioned yourself with the leading indicators. I think as you mentioned, Korea is probably a very good gauge right now, and then the currency is still really ringing some alarm bells.
Exactly. I think you're seeing the divergence today. So you have the South Korean equity market coming back a little bit, bouncing. It's not really convincing. And if you look at the currency market, which you can see here on the chart, you can see that the currency continues to weaken. It has tried to strengthen today, but then in the second half of the session, it began weakening again. And I mean, if you look at this, it's one of the biggest trading partners with China. They export a lot into China. Your currency is typically not weakening if there was a strong rebound case in China. So I think this is just further evidence of weakening in China. As we talked about Trend Economics, this Twitter account that we also follow in China, she posted this fantastic chart from Financial Times where they use the Baidu, the big search engine in China. You can see Chinese people searching on being unemployed, and fear about unemployment is now risen to levels that are higher than even during the financial crisis. So there is a lot of stress in the system, and that's why I'm not really believing the OECD leading indicators that there is a firm rebound.
Probably also a few more on the internet today than there was 10 years ago, but
obviously, but that's a good point.
It's showing some nervousness there.
Yeah.
Well, where can we hide, or where can we go to when we have these uncertainties in the markets? I think we've been talking about gold as the go-to safe haven. We've been quite disappointed about its performance over the past couple of weeks, where normally when you see weak stocks, we see a dollar which is a tad weak as well, and we see bond yields going down. That's normally good for gold. It hasn't really been up until yesterday, and I think that that escalation we saw yesterday, the market really didn't like that, and gold took that quite well. And Kim, you've been talking about this head and shoulder, which seems now to be null and void.
Yeah, it's been busted basically when we broke back above the neckline. As we can see here on the chart, we had that massive move yesterday. It tried a couple of times the past couple of weeks. We're trading below and trying to get back above the neckline. But yesterday, massive move. I can remove all the H and S from the chart because it is busted, and I think we will move further high from here.
And the thing is, obviously, if we are looking at gold, potentially maybe not gold against dollars is the best place to be.
It's more interesting, yeah.
If we are worried about an escalating trade war, then one of the weapons that China has is to weaken their currency further. And obviously, there's a lot of focus on the 7 level and against the dollar, renminbi against the dollar. And if we see an escalating trade war, we're likely to see gold high as well. So then that basically brings us to gold trade in renminbi. And I've got a chart here, which is the one that can trade on the platform. XAU, CNH, and we had this breakout last December, and we rallied up, had a 50% correction, so it's actually holding on to its Fibonacci's, and now we're breaking high again. So I would argue that if we do see an escalation, then the gold trade and the renminbi is the go-to contract to keep an eye on. Another place that we should probably also be focusing is the dollar. And again, we are almost getting tired about talking about the euro dollar because it's not doing much. But if just take a look at the chart here, we do have this 112.65 level above, which is a triple top right now, and that could potentially attract some momentum buying if we break above. Just a reminder as well that the short in the euro dollar against the dollar, the euro short is at a 30-month high, so there is some short covering to be had if we start to see some momentum there. But 12.65 is really the level.
Yeah, but And the only way I think to really play the euro dollar from here on is probably via some options. Bet on increased volatility. I think it's very difficult to predict whether we'll be going a lot higher or a lot lower, because it really depends on the dynamics. Because if we have risk off and the global economy slips into recession, typically the dollar is getting bit. But on the other hand, a lot of evidence yesterday that if we have heightened trade war concerns, then the dollar is being sold off, because there's weaker trade means weaker demand for dollars. So there's a lot of offsetting interactions, and we don't know really what is the biggest driving force. But just the low implied volatility, I think, is perfect for setting up some option strategies into the euro dollar.
Point taken. Want to look out for. Right, we are running out of time, but let's just return to Europe, because we got a key number coming out from the Germany today. We'll just take this before we take a quick look at the DAX chart. The ZEW, Peter, your comments on that one?
Yeah, the ZEW, always important macro figure. It's the first figure we have on the Eurozone and Germany economy on May. It's a survey about economic expectations for growth. And as you can see, we've had a pretty sizable rebound over the past 3 months. Last month in April was 3.1, and we're looking at a 5.3 expected, so further improvement. If we get a downside surprise here, I think that could actually put in some additional selling into the DAX futures here. And
talking about the DAX future, let's just move straight to the chart. Kim, a few comments on the DAX as how it's behaving?
Yes, I've been talking about this gap that DAX did back in late March, early April. Very close to close that gap. Let's see with the next couple of days. We closed just a few points above it at 11,854. If we close that gap to the downside, well, then there could definitely be more to the downside. No question there. And also what we have seen, just to add to that, and both in the S&P, well, around the table basically, we saw falling volume on the way up the past couple of months, and now we've really seen volume picking up massively across the board, across the markets.
Yeah, that's interesting.
In the selling.
Right, just before we take the calendar, which is fairly light today apart from the ZEW, I just want to highlight the grain markets, because we have seen this dramatic sell-off, which has been obviously trade war related, but also the fact that we got bulging stocks around the world. But just take a look at this update here. Corn is starting to receive some continued or some support here. The planting is moving forward at quite a slow pace right now. You can see there on the top left, we're well behind the seasonal average for this time of day. We obviously know that American farmers have got huge machines, so if the weather turns more friendly, they can get in the field very aggressively and very fast. But the longer this delay carries on, the higher the risk of corn acreage being abandoned and moved towards soybeans instead. So just bear in mind that we have a record short in corn, speculative short in corn at the time where we have this delays, and that's providing this quite big jump we've seen in corn over the past couple of days. So overall, maybe the one that has the best potentials if you look at the three grains right now. Okay, I promised the calendar, but I think we just need to mention the Lyft and Uber.
Yeah, we have to. So Uber, second day of trading yesterday, down another 10-11%. As you can see here on the chart, it's the Lyft and the Uber IPO is turning into, I think, a major disaster for Silicon Valley and Wall Street, particularly the lead investment banks that have been driving these IPOs. Too lofty and aggressive hot air balloons in terms of valuation, and it's a very tough marketplace to be a publicly listed company, and you're seeing that. The green line, I've indexed it to 100 as yesterday's close, so you can really see. Almost down 20% from the IPO price in Uber and Lyft. It's.
Have you got a target on Uber? Where would you consider?
I can't. No. We have, we have bets on the trading floor and where things are going, but I don't think that's for television. Otherwise, the compliance will just come running.
Fair enough. Let's finish off with the calendar for today. As I mentioned, it's pretty light. We got inflation numbers coming out of Sweden at 7:30 GMT, and then we got the ZEW at 9 GMT. Just to keep an eye as well on the oil market. OPEC's monthly oil market report will be out. Traders are caught very confused right now, because one day we're moving low on the back of trade wars and growth concerns. The next is supply tightness, which is back on the menu. So let's take a look at the OPEC's monthly report today, see if we can gauge anything from there. That's it from us. Thank you very much for joining. We'll be back again same time tomorrow. Thank you.